Joining us right now in the studios, Vighnesh Shahane, CEO and MD at IDBI Federal Life, and Ashish Vohra, ED and CEO at Reliance Nippon Life Insurance, to really cover all corners of the insurance industry. Gentlemen, morning. Vighnesh, if I could come to you first. Despite a strong growth outlook, like my colleague was just highlighting, private insurance players have seen a moderation of growth in the month of August. What's leading to this?
I think that could be a minor blip. I think private insurance industry has been on the growth trajectory post demonetization and has been for 2 or 3 years now. So this could be a combination of 2 or 3 things. One could be a high base effect. I don't know whether you're comparing it to last August or July. Sure. It could be a high base effect. But more importantly, I think a lot of the top 5 or 6 players have predominantly a ULIP mix in their products. Since the stock markets have been volatile over the last 1 or 2 months, this could have impacted ULIP sales. And thirdly, I think the focus of a lot of players has now shifted to protection products, which are lower ticket size, which don't give you the top line, but are more profitable. So I think it's a combination of these 3 things.
So there is no slowdown?
I don't think there's slowdown. I think there's been growth for a good period of time. I think the growth will continue.
Every other sector where government earlier had a dominant share, they've lost market share. Banks, telecom, airline. Insurance is one sector where LIC still has the large market share. It's not 100%, it's not 60%, it's come down, but they still have a large market share. So LIC on one side and rest of the industry on the other side.
That's right.
Why is this? Why is this so different in insurance?
I think various reasons. I think LIC is a great company. I think they have a huge agent network. They've got about 1.1 million agents. They've got a great product suite. So it's not going to be easy to dislodge them. However, having said that, I think private insurers are making slow inroads into the LIC market share. But it's not going to happen overnight.
Right. Ashish, I want to get you in on the discussion as well. Investors and analysts are pretty optimistic. Whoever we chat with says that, within insurance as well, life insurance is the go-to space, and this is something that investors can look at from the medium term to the long haul as well. What kind of growth projections do you think that life insurance could clock, in particularly your business as well, say over the next 5 years?
So, as Vighnesh was saying, we continue to be bullish on the life insurance sector, and there are fundamental reasons of why this sector would grow. The market does have some differentiation. There is clearly the investor side, which buys more ULIPs. That is a little sentiment driven, and depending upon how markets are performing, they sort of slow down or pick up pace. But there is a relatively larger stable base of savings products that the industry sells. There is also a rather large and stable base in the tier 2, tier 3 towns that consumes these products. My view, I think the next 5 years CAGR would continue to be upwards of 15% at a market level, though the composition might change from ULIPs to protection to savings, depending upon how the market is going and behaving. Fundamentally, we see the NOP, the number of policy trend, to be stable. And as you would know, when a customer purchases a ULIP product, he tends to put in a larger amount of money. Maybe 70, 80,000 rupees per policy is the average. And when the customer purchases a savings product, he puts in maybe 40, 50,000. When he buys protection, it's probably 10 to 12,000. So when you look at the industry as a whole, you might see it growing at 10% or 20% depending upon how the composition is moving. However, when you compare number of policies, and that's the true measure of penetration of insurance, we see a rather stable trend for the next 5 years. Short answer to your question, a 15% growth rate is what we would outlook per annum.
See a situation after, Ashish, after 3-5 years that instead of 20 players, we will be left to 12, maybe 15 players. Because for a market which is growing, and for a market where life insurance now is a fairly penetrated, business, it's not like internet. Internet was not penetrated, and because India was growing, internet penetrated last 10 years. Life insurance is very penetrated. The number of smaller players will be marginalized. They'll be forced to shut down or forced to merge.
Well, this is a bit of a debatable subject, and let me first sort of respond to the question of penetration. There are various ways to measure penetration. I would argue that at an average level, the total amount of sum assured that a customer carries today is less than 1 year's total income. And I would argue that that is not sufficient penetration. The total amount of protection that a customer carries in a Western world is probably 10 years of income. Even in neighboring Asian countries, the total amount of protection a customer carries is probably 3 times or 4 times. And the word protection is really the sum total of sum assured of all the policies that he owns. So I don't quite share the view that insurance is a completely penetrated item in India. It is way short of what even the Asian neighbors are, or what in someday the developed world, or we would get to the developed world numbers. Your second question around consolidation actually depends fundamentally around how some market forces pan out. For example, how would insurers end up modifying their distribution models or building in digital value adds? And I'm not just talking about pure digital distribution. I'm talking about using digital mechanisms to value add to the business, bring in cost efficiencies, and therefore value to customers. I think there is some progress that's happened there, and yet there is much more that is happening and yet to happen. The other determinant is really how will bancassurance play out. There is open architecture that came into the country about 3 years ago, but several large players, large banks, haven't yet moved into the open architecture space. And if they do, that brings in more opportunity for some of the smaller players to participate in that space as well. In short, to sum up your question around consolidation, can some of that happen and is there opportunity? My answer is broadly a yes. However, does it mean that all small players will get marginalized? My answer is broadly no. It depends upon how they take advantage of some growth in the market and modify their own distribution models to keep ahead.
How does one, attempt to grow the space even further, whether it's awareness, product innovation, distribution? I mean, how do you see the space becoming, a little bit bigger?
I think, I've been asked this question a lot of times. I think the biggest challenge the insurance industry faces today is a trust deficit with the customer. You talk about high GDP, low inflation, stock market volatility, regulatory and government instability. If all that was to fall in place and the customer yet didn't trust you, penetration would be a problem. And I agree with Ashish on his definition of penetration. So I think the first thing is to woo back the customer. And the regulator has taken laudable steps in doing this over the last 5 years. Every regulation you see has been in making this industry more customer-centric. The second thing is simplicity. I think the word creativity in insurance products is often used. It's simplifying. Creativity is simplifying things, like rightly said. I tell my product team that the geniuses sitting in the boardroom designing products are not the ones who buy and sell your products. They are simple men and women, undergraduates, graduates, single mothers, senior citizens, kids.
They want lesser forms, they don't want jargons, all of that.
Absolutely. To that extent possible, I think making the industry more customer-centric and simplicity of products. And obviously, the retail channels have been increasing by the day. There was agency, now there's agency, bancassurance, brokers, digitalization, technology. I think combination of all these things will help in increasing the space.
But can these tools help you eat into LIC's market share? We know they've had a first mover advantage of decades almost. As an industry, how much of their market share can you really absorb?
Well, like I said, LIC is a great company. They have a superb retail network of agents. I think it's not going to be an overnight battle that you win. It's going to be an aggregation of small steps that every player takes, starting with product distribution. Like Ashish rightly said, how bancassurance plays out. And LIC is not a big player in bancassurance. And I think bancassurance will remain a dominant channel for some time to come. So it's a combination of a lot of things, doing a lot of things right consistently over a period of time to start nibbling at the LIC market. LIC is a great company. They've got a great product suite. Their customer service is good. They've got a great retail network. So it's not going to be easy. But is it impossible? Not at all. But I think we have to nibble away.
Okay, gentlemen, really appreciate your time. Thank you for joining us.